Well, thank you, Mattias, for that. I'm Neil Day, Managing Editor of the Covered Bond Report. For those of you who don't know me, I'll start off by thanking the ECBC for inviting me to moderate this panel. I've obviously been coming to all the plenaries over the past years, listening to the discussions about what might happen, a lot of speculation, and it's very nice to be here now on the occasion when the directive is almost completely through. I've got some expert panelists here who have been involved in the discussions and who will maybe be affected by the directive when it comes into force, and will be working hard to adjust, as Mattias said. I'll start off by asking them all to introduce themselves briefly so you know who they are beyond the names that might appear up there at some point. Dario.
So my name is Dario, Annoscia. I worked in the office of the shadow rapporteur for the S&D group on this legislative package, and we were also on the own initiative resolutions back in 2016.
Good morning. I am Stefano Patruno, working for Intesa Sanpaolo and responsible for European regulatory policies. And formerly, I ran the covered bond management of Intesa Sanpaolo.
Hello, good evening. Cláudio Domingues, working for Millennium BCP, involved in the medium to long-term funding strategy of the bank, and with particular responsibility over the bank's covered bond program.
Good morning, I'm Morten Bækmand. I work for Nykredit in Copenhagen. I represent the I represent the Danish issuers in the ECBC steering committee, and also heading the technical issues working group at the ECBC.
Good morning, I'm Jakub Niesluchowski. I work for PKO-BP Group. I used to be a CFO in our mortgage bank. Now I moved to mother company, and I'm supervising a finance division, including group companies, and including also covered bonds.
Right, thank you all. So with you, Dario, I mean, you mentioned the own initiative report. That was, I think, the Parliament's first official intervention in thinking about covered bonds as something that maybe needed legislative action. Thinking about what the position of the Parliament was then, and looking at where we are now, perhaps you can give a bit of a perspective, kind of parallel to what Mattias gave us from the Commission's point of view.
Yes, thanks, Neil. We, as a Parliament, started the work on a pan-European covered bond framework back in 2016, so 2 years before the adoption of the Commission of this legislative package. And we started to, let's say, brainstorm on among the different political families on the key issues related to covered bonds. And at the end of the legislative package, now the legislative process, I can say that many of the elements in that resolution are in this text, in particular for the directive. Notwithstanding reaching a political agreement on this package was particularly difficult, as it was mentioned several times today. Covered bonds developed differently across the EU, even if there are specific elements, common elements, but the development is different. In the end, in February, we managed to reach a compromise agreement, which, in my view, bridges gaps between the various political families, the co-legislators, so the Council and the Commission, and also addresses the main concerns of the operators. We reached this agreement with really a true European approach, and our action was basically focused on three aspects. First of all, prudential aspects, so addressing risks and vulnerabilities in the market, credit concerns coming from, I don't know, for instance, deterioration of assets in the cover pool, So we elaborated a number of provisions in the directive, so on cover assets, cover pool, liquidity buffers, extendable maturities. All these provisions really required a lot of efforts from our side because there were different views among the member states and the political families. Second aspect linked to the previous one, to the first one, is to try to harmonize the supervisory practices and improve the transparency. This is a very important element of the package and creates a kind of a level playing field among the operators in the markets across Europe. On this, I have to say, there was a broad consensus among both within the European Parliament and between the Council, so the Member States and the political families. I can go a bit deeper into the details later on the main aspects of this area. And finally, as Mattias said, we tried to, let's say, to trigger a further harmonization process, as I would say, because clearly this was the first attempt to harmonize well-functioning national cover bond systems, and was not easy, as I said before, to find, let's say, to compromise on all aspects. So we left some issues to the member states. And we can come back on this because it's very important for the operators and the national authorities. But then we decided to, let's say, as a way of compromise, to trigger this harmonization process. So, as Mattias said, medium period, there will be the transposition in all member states. And then, so the setup of the competent authorities, supervisory authorities, and then the Commission will start working on the report, analyzing the aspects that Mattias said. So whether there are risks within the extendable maturity structures, the liquidity buffer, the over-collateralization, the exposures to credit institutions in the CRR, and possible creation of the European secure notes, which were, let's say, really pushed from my group, the Socialists and Democrats. Was not possible to include this element within the cover assets, so riskier asset and mixed cover bond cover assets with the ESN, in order to adopt this package as soon as possible, but we hope that with the help of the operators and the Commission will soon launch the process on this.
Right. Okay. Well, thanks for that. I mean, we'll come back to, like you said, various points there. I should probably try and clear something up, or ask you to clear something up a bit. That I know that not everyone is very clear, 100% clear about. There's been mentions of things not quite being finished, of further votes in council and things. And people are a bit in the dark. I got an email just a minute ago from an analyst asking, why I'd said there was going to be some kind of a delay when I wrote about it last week. So what exactly is the process now in terms of really finally getting the directive and the whole legislative package signed off and approved and to come into effect?
Yeah, so from now until the transposition, the publication in the official journal, let's say. The Parliament last week adopted in plenary the compromise agreement reached in February among the institutions on the content, so this is the final text. However, considering the limited amount of time we had, the lawyer linguists in the institutions have to translate all the legal text, not only cover bonds. In the last plenary there were 20 legislative files. They will translate in all languages. So in the meantime, so at the first council meeting, the council, so the member states will approve this compromise agreement. In the meantime, lawyer linguists will translate in all languages the text, and there will be a very quick vote, but only if there are corrigendum in specific languages, like Gaelic or Italian or other languages. It's just a linguistic check. In July, we hope, there are 2 plenaries in July. We hope in July this will be voted on. Then there will be another voting council, and finally the publication in the official journal with the timetable that Mattias presented. So basically we have until September, October this process, publication in the official journal, and then from then we have 18 months plus 12 for the adoption, which is also, in my view, another important element of the package. You know, we was not problematic to find a compromise, but on this. But the development, even on the transposition, was not easy because the Commission proposed 1 year, the Parliament 2 years. Then with the Council, we decided to have 18 months for the transposition and then 12 months for the actual adoption at national level.
Okay, well, hopefully that's cleared things up for everyone, if they were still confused. We might have a couple of questions at the end if you have any more. Turning to the operators, I think, as you call them, the issuers and banks that will be affected by either positive or negative by the directive. Stefano, if I can just start by asking you, I mean, obviously there were lots of warnings about all sorts of contentious issues throughout the whole process, right from the start up until the 11th hour, it seems. Obviously, you've been trying to defend your country's interests and things. Were you concerned that there was going to be outcomes that would be unfavourable to your jurisdiction?
Yes. The answer is yes. We had some concerns as the whole framework that was proposed, what was initially proposed, and then as the discussions went on, there were some aspects that were not, in our view, sufficiently taken into account of certain national markets, some national markets that were already established, already known, and which had a sound legal framework. So we did run the risk of having a market disruption. We did. In terms of, for example, I will just quote two examples. One is maybe we can go further into details after with my colleagues, but one was the extendable maturities, which is now let's say the majority of the new issuances in European countries are extendable maturities, so there should be no penalization on that. And secondly, there was the whole concept of coverage and the use of derivatives did not take into account the national specificities of certain countries. So we had, together with the industry, with the ECBC, we really struggled to make these points clear and just to avoid disruption where markets were already functioning. So this was our purpose. So in the end, we reached, I think, a compromise which was very welcome. This was reached really at the end of the process. But now we will have to transpose into national law. And what I have to say is just to point out a little paradox is that when transposing to national law and when to amend national legislation, this should be done in order to, say, increase the overall level and soundness of the national framework, in order to be to comply with the directive and the framework. But I can say that for my country, for Italy, for instance, we will have to make amendments to national law, not to increase the level, but just to comply with certain features of the directive, which will make the process more difficult, and maybe from the beginning, maybe this was not the intention, but this will have to be done. I will stop here.
Okay. Hopefully you might be able to do it a bit quicker than when the legislation was first introduced in Italy, which I think took a little while. If I can just come back to Dario actually on this point, I mean, on the kind of 11th hour discussions, I mean, how do you go about finding a compromise and getting a compromise on something like that? I mean, you know, the shadow rapporteur and the rapporteur, I think, you know, the rapporteur, Bernd Lucke, had some very tough positions. How did you get him to, and people to change their mind on the kind of things that Stefano was looking for?
Yeah, well, the negotiations were twofold, in the sense that before the vote in the Econ committee, where there were the negotiations among the political families, and there was a kind of battles between the SD, the EPP, the various groups, no, and the rapporteur, and then all the parliament, so with the Econ text, with against the member states, let's put it like this. We found a compromise on, I would say, on almost everything, and we did it in two ways. The first one, leaving to member states, for instance, to decide on certain things, like, for instance, in the Econ report, there were specific numbers, or no, there was the request to the European Banking Authority to come up with reports on granularity and diversifications of cover assets. Whereas in the final compromise agreed by the co-legislators, we left this to the member states. And another way was to soften the positions, like the rapporteur was pushing for, let's say, different risk weight for extendable maturities. This was seen as a problem from my group, for instance. So we decided to call on the Commission to examine this specific point, because our goal was to obtain, to reach a compromise which harmonized just the principle, minimum harmonizations we call, but at the same time to preserve the Covered Bond brand. So no disruption at national level, and was not easy. So these were the two ways of reaching, let's say, a compromise. I can say that the last trialogue finished on the 26th midnight, and basically on the plate until the very last minute, there was, if I can say this, there were four topics: the inclusions of credit equality step 3 in the CRR, the inclusion of the paragraph on sanctions, well, the full system of sanctions as included in the Commission proposals, because the Parliament removed part of the sanctions. Third, the issue of loans to public undertakings in the cover asset and the level of over-collateralization. And finally, the labeling. The two labels for the cover assets, so the premium European cover bond and European cover bond. So we managed in the end to include the compromise on these four issues was to include the credit equality step 3, but with 80%, so in between the 5, the European Parliament position and the Council 10, include the full system of sanctions and penalties, and on our side, the 2 labels and over-collateralization up to 10% for loans to public undertakings.
Okay.
If I may just briefly compliment, I would like to, in trilogues, of course, there's the other party as well, which is the Council. And let me take the occasion to pay tribute to the Romanian presidency who represented the 28 member states, which is not an easy task when you sit at these kind of late-night discussions where you have a mandate which is often fairly strict, but you know that you have to get an agreement, which means that during these negotiations, whereas the parliamentary team were in the room, the presidency, of course, had to kind of go out from time to time and consult with key selected member states to ensure that where the discussion was going was an acceptable place. And that's typically the trilogue negotiations, process-wise. It's a very, very heavy task for not only you guys, but also the presidency, who have to then kind of consult throughout the process under very, very heavy time process. And sometimes for ourselves as well. You mentioned sometimes we come in as honest brokers to provide a technical solution to the problem, ideally by yesterday. And that is not always easy either.
Right. Okay. So yeah, turning back to the operators. Cláudio, I mean, perhaps just a general kind of view on how you welcome or not the directive and, you know, what it means for your jurisdiction.
Portugal might have a relatively particular case here, as everybody else probably. By the fact that it came relatively late into the European covered bond space, facing the reality of a relatively small domestic market and the need to assert itself and its issuers among the more established, European covered bond markets, led both legislators and practitioners into picking up the best features of existing legal frameworks at the time. So the result was that what has been widely acknowledged by investors over these years as, a robust and even actually rather conservative piece of legislation, which is also the byproduct of that giving us has given us a bit of comfort when facing this whole harmonization exercise. Of course, that all said, as issuers, we have always have issues that raise some eyebrows. I will name a couple of them. First, I think it would be probably the loss or the so-called loss of the discretion of the extension of the covered bond maturities. Not the loss of discretion per se, because it's something that a market that existed for 12 years has never used. And may I remind what those 12 years have been for a country like Portugal. The deepest financial crisis in a century, with a liquidity crisis to match, no access to the capital markets whatsoever, one bank insolvency, and not one single mention even to the idea of extending a covered bond maturity. So much for the optionality or the discretion. It's there, it's theoretical, it's in law, but in practice it's not a real option for, I'd say, obvious reasons. So it's not much the loss of discretion, it's the triggers associated with it. This is still in the open, as we know. It started by the concern is how will what will these triggers be? No one mentions some possibilities, and how would this maturity extension work in practice? How would they be triggered? What sort of discretion would have local legislators in the process, etc. And things got a bit tighter from our perspective when in March in 2018 the Commission's proposal required for these triggers to be defined in contractual terms, and then these things have been moved into them being required to be established in law, which can be in terms of practicalities and flexibility in this whole process can be a bit trickier to undertake. And of course, triggers became financial triggers. Again, more question marks. What would those be? Because we cannot run into the risk of, dying from the cure instead of dying from the disease. Yes, loss of discretion, but we need to be careful now how we draft these things, and I think that the transposition phase will be absolutely key for this.
Okay, thank you. Dario, did you want to add something on that?
Yeah, extensions. This is one of the cases that I was mentioning before, where we left to member states to decide. I think, in the European Union, there are different approaches on this topic, So we had to take a positions. And the best one, in our opinion, was to leave to member states the discretionality to decide the triggers instead of leaving to another, maybe to the Commission or to the European Banking Authority this. And this is the outcome of a compromise between the political families and the member states. When I said before that this is a very crucial moment at European level, because the work is starting now for the covered bond, let's say, European covered bond framework. I was referring really to this type of issues. The European Covered Bond Council gave us a lot of, provided us with a lot of help and let's say also experience from the operator side. But now I think that the work will continue. In my view, there should be like committees among member states, like cross countries, committees collecting best practices on these specific cases. Because now it's the member states that has to decide on the triggers, specific financial triggers. But we can't now, after all this legislative process, that there is an heterogeneity of, for instance, in this case, of triggers in the European Union. So now I think there should be like operators, national authorities, let's say, meeting and deciding on the specific.
If you can give it a brief, Cláudio, just so we can get everyone to have a bit of a say, yeah? Yep.
Well, just forgot to, the other aspect that raised, well, at the beginning, especially over the summer, a degree of concern was the famous liquidity buffer, which again, not the liquidity buffer per se. I mean, some of our programs have already liquidity buffers because it's credit positive, so some institutions took advantage of that. But is much more on the side of how do you size it? And we were a bit concerned when we, with the possibility of we as issuers having to take into account the principal outflow upon maturity, which in our view, we understand where that comes from, and it makes sense for, large established hard bullet markets with a lot of step 2 credit quality banks, but for smaller markets where issuers are not step 2, probably at step 3 and improving, but still step 3, and but being soft bullet, we thought of it as somewhat unnecessary and somewhat costly and probably in some cases rather unpracticable. But fortunately, I mean, and that I think that the role of the industry there was critical just to gather some sense, and member states were left with that discretion of being able to choose between the actual maturity or the extended maturity for that purpose, so which makes a fundamental difference.
Okay, I'm going to have to move on a bit on the thing. Morten, so thinking a bit more maybe big picture, now Denmark obviously has quite a unique system compared to everyone else, and if there was ever an example of kind of the overarching aims and concerns that Mattias mentioned at the beginning about not disrupting well-functioning markets, do we need harmonisation and things like that? Denmark's probably the kind of test case for that. Yeah, overall, how happy are you with the results, and is it a good outcome? Is it going to disrupt? And briefly, maybe if you have to change anything.
Well, we are quite happy with the result. We think it's been a good process. We think the original proposal from the Commission was pretty close to spot on. There was a need for amendments here and there, and they worked through. So overall, we think this is a very good result. In the process, of course, with the classic Bismarck quote saying that you shouldn't let people see how you make laws and sausages. There were, of course, compromises here and there, but they were good. And of course, we had concerns along the way, primarily regarding what type of assets will go into the covered bonds. That was a concern that I think we shared with other jurisdictions, because we wanted to make sure that there was no watering down of the quality of the covered bond brand. So that was super important to us. The discussion about the extendable maturities was also one that we followed very closely, and as Dario mentioned, at one point in time it was proposed to have different risk weights for soft bullets and hard bullets, and we think that would have caused major disruptions in the market. So we were very happy to see that being taken out again.
Right. Okay. And Jakub, I mean, Cláudio's already mentioned about Portugal being a relatively young jurisdiction when it comes to, I suppose, participation in Euro benchmark covered bonds. Poland's even younger, and you've led that way. We're here in, Central and Eastern Europe, talk about a lot of potential. What does it mean, the directive for your jurisdiction, and do you see it as helpful for new jurisdictions potentially coming in?
So I can say that we are one of the examples of the country. Yes, we are a newcomer, I can call it in this way, that change in law, generally an improvement of the law, can really boost the market. Yes, because we are not present on the European market, and starting 2016, when we had a new law, we already got a €5 benchmark on the market, one sum benchmark, and generally additional mortgage banks are appearing on the market. So that is a positive sign of the robust regulation, yes. And so now I can say I wish we had a directive a few years ago, because we had a long, I would say, and difficult way with our regulators to actually establish new law. But thanks to that, now and looking on the Covered Bond Directive and the regulations, we are pretty much aligned with the standards, yes. But from my point of view, I'm really happy that we have such standardization from few reasons. One of the reasons is discussion with regulators, because as a newcomer, we always, maybe not always, but in many cases had discussion with the investors. Okay, how do you compare to Germany, to other more established countries? And now we can say, okay, we have pretty much the same framework, yes. Of course, we have national discretions, and this will be discussed. Extendable maturities is one of the most heavily discussed topic. Here I can join to my colleagues, and having such structure in Poland written in law, I'm happy that the idea of increased risk weights is not in the final regulation. So that's very positive for us, because we saw as okay, we work on the law, and the final end, such I would say idea or such regulations will actually, in my opinion, destroy our market, which actually is at I would say early stage at the European scene. Another element is that as a new market, where I would say on ongoing basis discuss with regulator, okay, how what else can we change to actually improve the market on the issuer side, but also on the investor side. And here directive, from my point of view, in transposition to the legal framework will be prerequisite to really make this discussion with regulator intensive and also improve not only based on what is written in the or adjust what is in the directive, but also address other elements. Because here I see, as I mentioned, and I will underline, also we look on the investor side and how to actually increase the capacity of the Polish market. And here also, thanks to EBRD, we're working on it, and EBRD is very active on our market. And here, as from newcomer market, regulation one thing, but also the investor side is very important.
Okay, thank you for that. Just quickly, we're running out of time. Going to come back to ESNs, looking forward a bit again. Stefano, I mean, it's no secret the Italian banks have shown an interest in that. You're disappointed about the way this ended up, kind of a bit of a missed opportunity? And are you convinced that there will be action going forward, or is it a bit unpredictable, especially with the new commission coming in and the new elections?
Well, yes, we would have, thought of more courage in pushing for ESN in this very occasion of the Covered Bond Directive. However, we have this opportunity to introduce. I hope. Well, Mattias talked about in the long period. It is not going to be very long. However, 2 years are quite long. Then it has to be discussed, and then it has to be received by each national legislation. So it is going to be a long period. So first of all, we hope that it will go through because it is really needed. I mean, we think that this directive opened for new asset classes, some niche asset classes like public undertakings and so on. But what is really needed, we believe, for the European growth are dual recourse instrument based on what makes the economy grow, SMEs and infrastructure loans. So no niche, but the real structural characteristics of the European economy. So yes, we were a little bit, yes, we hoped that, seeing the initial report by the Parliament, which was very courageous 2 years ago, they introduced ESN. So yes, we expected that to be a little more pushy, but we also understand that, as it was mentioned by Dario, the negotiations on this package were getting quite difficult at a certain stage, so there was no room for discussion on ESN, and this we can understand.
Okay, if I can just ask, because we're running out of time, Mattias and Dario, just give it kind of 1 minute each to just either respond to that or anything else that was kind of picked up on in what the other issuers have said.
Okay, I'll respond to this one, perhaps during that 1 minute. Essentially saying that that's a very simple reason why we didn't do it now. We didn't have the time. We concluded this process last week. If we would have had additional issues, it would have taken more time, essentially. We have a lot of material now, thanks to, we have EBA recommendations, we have a report that Richard Kamish has drafted, we have responses to the consultations, we have a lot of material which already would allow us to carry out a fairly good report, I think, and the legislators in their wisdom decided to impose a certain time limit on that one. We may need some additional material from perhaps the EBA on some of the instances, kind of based on the input we've got, notably in terms of preferential treatment or not, and these kind of things. But I think the process is underway, and as the Vice President indicated yesterday, we're working on it, but politically, of course, there's a change for the next Commission to decide.
Dario, did you want to pick up on anything just briefly?
On Cláudio's criticism or point of discussions on liquidity. There were really long discussions on liquidity buffers with regards to two aspects, let's say the overlapping with the LCR and the liquidity buffer vis-à-vis the extendable maturity structures On the overlapping, there is now a statement from the Commission clarifying that they will review the LCR. On the liquidity buffers in case of extendable maturity structures, there is a very clear recital 21, which clarifies the exact time when you have to consider the liquidity buffer, the 180 days for the liquidity buffer in case of the extendable maturities.
Okay, we'll take one question, so be quick and make it a good one. Is that too intimidating? Okay, never mind. We will leave it at that then, and we've used up our time. Thank you to all my panelists. Thank you to you for listening. Thank you to the ECBC for having us, and on to the next panel.